Good morning. My name is Mary Tressel, and I want to welcome you to today's webinar, 3 Key Lessons from a Startup CFO. Armino is happy to be producing this with the Brenner Group. First of all, I want to walk you through how to use your webinar pane. So if you see in your upper right-hand corner of your screen, a little arrow, orange arrow, you can hit that arrow to expand the box and type in a question for our presenters. We will answer those questions as time allows at the end of the webinar. To minimize the pane, simply hit that orange arrow again and it will be smaller on your screen. You also want to make sure that you have the correct audio settings selected so that you do not get an echo sound as you listen to our webinar today. So make sure if you're using your computer mic and speakers to choose the computer audio selection. If you've called in, please check this phone call button. All right, with that, I will introduce our presenters. So first we have Andres Verschelden. He's a CPA and MBA and CEO of the Brenner Group. It's a leading Silicon Valley financial services firm. Andres manages the portfolio of more than 100 venture-backed startup clients. He has great experience in managing consulting and financial services projects, and he has an MBA and a New York State CPA. He's also the co-chair of the Moore-Stephens Harvard University program. Our second presenter is John Stevens. He's a CFO and CPA. He's a consultant with the Brenner Group, and he has over 20 years of executive finance and accounting experience. John's got a broad suite of corporate finance, budgeting, revenue management, pricing, M&A, and technical accounting background. He also focuses on digital media and SaaS software industries in his client base. And we have Scott Schwartz, a director with Armino. He is a practice leader within our CFO advisory group. Scott has worked with hundreds of clients, private and public, providing financial and consulting services, as well as working directly with entrepreneurs. He has extensive experience in equity compensation and valuations, and he works with finance executives on their stock-based compensation and other equity transactions. So we do feel like this is an important topic for our emerging CFO audience here.
Thank you, Mary. Good morning, everyone. This is Andres. So before we get started, I just wanted to spend a few minutes and talk about the Brenner Group. As you can tell, that's the logo that you're looking at the left bottom of your slide, and Mary already hinted at the fact that we're hosting this together today. But a lot of you might be wondering, so what is the Brenner Group? Well, it's part of Armino, but it's a bit of a different service offering and a bit of a different approach. We really provide solutions through individuals, and those individuals tend to be very senior financial executives, either at the CFO or at the controller level. And so a typical CFO at our organization would be spending Monday and Tuesday at an automotive company, a self-driving company startup, maybe Wednesday, Thursday at an artificial intelligence company, and then on Friday they might be working on a turnaround project. And so we work with growth companies, we work with companies that are going through some level of turnaround or restructuring, and we also help companies, not just startups, but middle market companies that are trying to identify senior financial talent, so CFOs, VP Finance, director level, etc. So that's the Brenner Group.
I won't go through this slide in total, but within Armino, we offer a variety of services, but within our CFO advisory group, we offer equity management, valuations, and kind of our catch-all financial management, technical accounting solutions. Within our equity management, equity compensation practice, we do option administration, cap table management, implementing stock systems for our clients out there that are on Excel today, and a big portion of what we do is equity accounting. As Mary referenced previously, we work with both private and public companies, and that even flows into the valuation the work that we do, 409A valuations, private companies, but working on purchase price allocations, derivatives, and the like for public companies as well. And then, as I mentioned, our catch-all financial management, warrants, derivatives, transaction advisory services, due diligence. If you're going through an audit and you haven't ever done it before, or you just need to clean up your books, and don't have on the slide, but something that everybody should be thinking about is the revenue recognition. That's a key area of our financial management group, which if you're not thinking about it, you're behind the game. So not part of this webinar, but something to consider. As we talk today, we wanted to kind of frame the conversation about stage of development, and this is a framework that Armanino uses across the company, whether it's audit, tax, or consulting services. And the Brenner Group kind of shares a similar vision. Today, we're going to really focus on the first two stages. So startup and rapid growth is where we're focusing. Again, we might have folks today that are in the startup stage, might have a few employees trying to get to that next rapid growth stage, or perhaps you're in the rapid growth stage and then trying to get to become a more established, more automated company and move to the next level. So we're really going to be focusing on those first two buckets today.
So what are we going to be talking about today? Well, when we started thinking about this webinar, we thought, what are the three key things that our startups typically look at us for and ask some help with? And the first one is sort of more high level, what are some of the best practices in accounting and finance? Second, the financial strategic plan and the annual operating plan, and of course fundraising related to that, is something that every startup needs help with, and that we play a major role in that field. And then lastly, the stock option plan and looking at it from a few different angles is something that every founder and every startup has to deal with as well. But let's set the stage before we really dive into those topics. Let's set the stage and look at how the market has been performing and how the startup fundraising environment has been doing. And so if we look back at 2016, we have to acknowledge that the market cooled down a little bit. And this was actually a good thing. Our feeling was that valuations in 2015 were just going a little bit through the roof, and the market was just getting a little overheated. And so it was very positive to see that there was a bit of a slowdown. It was not a steep correction, but there was definitely a bit of a slowdown. And so you can see that in both the amount of dollars invested as well as the amount of deals that closed. Again, we thought this was a positive evolution. But what that meant for the conversations that were going on at these startups and in the boardroom is that lots of startups were actually talking about cost cutting in 2016. There was this whole, everyone was looking for this path to profitability, and that's all good. You know, there's nothing wrong with that. But as we're getting now further into 2017, you can tell that the market is getting a little warmer again. And our sense is that we've had a pretty bullish start of the year. And it's the same reasons why 2016 was not a hard stop. It was not a steep correction. It was a slowdown, and again, a slowdown that we welcomed. But there were a number of factors that allowed the market to stay pretty hot and with lots of liquidity. And number one reason there is you've had a tremendous inflow of foreign capital. And we could go through a number of examples here of startups that have benefited from that. But between Baidu, Alibaba, SoftBank, Temasek, and the Saudi Wealth Fund, there's just been a tremendous amount of capital influx into Silicon Valley. And we expect that to continue over the next few years. Secondly, on the corporate VC side, we've seen a huge increase over the past few years in the amount of dollars invested. What's interesting is that you've got both your traditional technology companies that for many years have had a venture arm. So, you know, think about Intel Capital, Google Ventures, Qualcomm, Salesforce, Cisco. All of them have a pretty active venture portfolio. But what you see happening now is that a lot of these more traditional industries and Fortune 500 companies within those spaces are becoming more active in the venture space as well. Think about the automotive industry and what's happening with self-driving cars and the way that GM and Ford and BMW have all made significant investments and have set up their own venture funds just recently. And then my last point there is probably the most important one. The VC community, the sort of traditional VC community on Sand Hill Road, has really raised a lot of money over the past few years. And just in 2016, $42 billion was raised. And so we expect that those dollars are going to be deployed over the next few years. One additional point that is not on the slide is that just a few weeks ago, Snap had a very successful IPO. Stock went up 42% first day of trading. And so there's also the public money side, which is harder to predict. But if the IPO window opens again, then that will also allow for additional liquidity into the market.
And I was just going to add to that. I mean, I think what we saw in Andres and I were talking about the other day in 2016 was a good amount of follow-on investment, right? And VCs protecting their investment, being a little bit more maybe conservative, but at the same time still raising a lot of money. And so when you don't have the outflows like you had in the past, but you're still raising the same amount of money, hopefully that leads to a big year for us in 2017, like we saw, in the 2012, 13, kind of 14, when a lot of money was held back before that, and then big funding afterward.
All right, and our first polling question ties right into that, so we're going to open it up for you. Please just select one of the options here. The following sentiment best describes my mood around the startup market. I feel very optimistic, generally positive, cautiously considering all options. I expect things to get worse before they get better, or I'm highly concerned about the market. So we're going to leave that polling question open for just a couple more seconds here to let you just kind of weigh in and let us know your thoughts on the startup market. All right, and it looks like we've got the majority of you have voted, so we'll go ahead and close that poll and share with you the results.
Yeah, so it looks like most of those who are attending today would agree with us that they feel generally positive about the startup market and what's happening there. And we asked the same question to our CFO consultants and our controllers, and we got a result that was fairly similar to what we're seeing. Maybe if we could just go back a sec and show the results of the online poll. Okay, that's what you guys were looking at. Okay, great. So if we're looking at the results from our what our consultants filled out, then this is pretty similar to what you guys filled out. Maybe just a tiny bit more conservative, which is what you would expect from your CFO or your controller, right? Yeah. But overall, pretty positive. Okay, so let's jump right into the 3 points that we're trying to make here. So the first piece is kind of high level, some strategic lessons, and I split up in 3 parts. The first one is around setting up a standardized process, and this is sort of it might seem a little self-evident, but you'd be surprised how many startups just start to implement systems and sort of buy these different SaaS solutions without really putting a lot of thought into what should the architecture look like of my entire best-of-breed environment. And obviously, as the company is scaling, that best-of-breed environment is going to change. But you got to really think about it similar to building a house. You want to have a solid foundation when you start, and then you got to be able to build some levels on top of that, some layers on top of that. And so we do like to spend a good amount of time with our startup clients as we onboard them, thinking about what does that architecture look like? What does that best-of-breed environment look like? Who has access to which levels of sign-off? What should finance and accounting really be measuring? What are our investors looking for? What is our board looking for, et cetera? And I just wanted to share with you guys what could be a hiring plan strategy. This is, of course, pretty arbitrary. It really depends from startup to startup. But as you're evolving from a formation stage into Series A, Series B, there's some combination of having an accountant/office manager, maybe a part-time CFO, and then you bring in a controller, and then once you get a little bigger, you're probably adding an AR or an AP person, somebody who's managing payroll, etc. So that's for standardizing your processes. Second, I want to spend a few minutes and talk about technology. And I don't think I need to convince this audience of the power of technology, but within finance and accounting, you really have to think about scalability. And technology allows us to do that. And the cool thing in our industry is similar to many other industries is that we've had a tremendous amount of innovation over the past few years. And so there's really a very wide offering of SaaS solutions within the finance and accounting space that we see startups deploying today. And I just wanted to share a few names here with you. At the top of the slide, you'll see a number of solutions that typically finance and accounting has ownership over and is really leveraging to manage their day-to-day reporting, closing up the books, expense management, forecasting, equity management, etc. And then at the bottom, there's a variety of solutions. There's some CRM systems. Obviously, both NetSuite and Salesforce do more than CRM, but we put them in this bucket just to make the slide simple. Once you get a little bigger, you start to sit on more data that you have to analyze. You could use something like a Tableau or a Host or Power BI, any of those solutions. If there's a payment component, you're probably looking at Square or Stripe. And then for payroll, there's a whole other variety of solutions, but a few that we see being used a lot these days, Gusto, ADP, Paychex, and Zenefits. The message for this slide is not so much here's the ones that are right and here's the ones that are wrong. If anything, what I want to emphasize here is that you really want to think about what is the right combination and how do we make sure these systems are talking to each other. If you don't integrate them, you're just not going to be leveraging the true power of these solutions. And so spending a little bit of time and money on how do we make sure these systems are talking to one another, and these integration packages these days really don't cost that much anymore. It's just going to drive so much more efficiency as you're scaling.
Yeah, just quickly add to that. I mean, I think we saw the writing on the wall a few years ago and have developed a large integration practice and assessment. So, I think it's deciding what systems you want when and then how are they going to talk to each other and what the process is going to be. Is it going to be best in breed? Is it going to be more of a suite solution? As Andres said, I don't think there's any wrong answers, but it's imperative that if you have an ERP system, now you want to add something to it that they can talk to each other, or your forecasting is able to flow in directly, your actuals from your ERP system, things like that are real important. And again, that's where we've seen just such a growth in the integration business.
Absolutely. All right, and that gets me to my final point, which is about how finance and accounting can be so much more than just reporting and compliance. And at successful startups, we see that the CFO and the controller very often become leaders that ultimately drive the company, be it in market expansion, be it in launching new products, be it in building partnerships, obviously in the M&A process, margin analysis, et cetera, et cetera. And so those responsibilities, I would say, are probably equally, maybe even more important than compliance, reporting, tax, your typical functions that you expect from your accounting department. And then I did want to leave you guys with a few more practical takeaways as well on how to do that. And very often within a startup, you've got a team of founders who are very excited about what they're doing, and there's a whole set of different ideas on what's possible and what we could be executing on. And finance and accounting can really be a gatekeeper. Being the team of people who can help the CEO in validating the data and making sure that we are executing on a strategy that is feasible and that is leading towards that next milestone. That can really be the goal that a good CFO, a good controller has to take on. And that means saying no more often than saying yes. And so really helping to identify and focus on those ideas that make sense. I think some of these other bullet points go beyond finance and accounting. So, fire fast, that's something that within the startup environment just makes a lot of sense. But I would say apply that as well to your service providers. And very much aware that we're one of those, but you want to set the bar high, and if the relationship just isn't working, then don't spend too much time on trying to figure out whether it makes sense to change or not. You want to be pretty quick. But in general, it just makes sense to outsource some non-core tasks and focus on what you're good at doing. And then be careful with titles. We sometimes see clients where someone has a CFO title, but they're just not a CFO. They might have been the person who was part of the founder's team who had an accounting or a finance major in college and kind of got that title early on, but it just creates a really challenging situation later on where you potentially have to demote someone, and just want to avoid that. And then my last one here, and we're really big on this, is you want to spend a lot of time and money on onboarding. It sort of goes back to my first point around creating processes and being very clear in what the goals and the KPIs are, both from a department point of view as well as from an individual point of view. And so you just really can't get away with hiring smart people and assuming they're going to figure out what to do. Okay, with that, I'll turn it over to John.
All right, well, thank you. All right, so I'm going to break my comments into 3 sections here. So the first, we'll dive into the operating plan itself. Then we'll get into KPIs and some benchmarks. And then the third section will be around fundraising. Okay, so the message here on this slide is that your financial operations, the sophistication, will essentially evolve as you grow. Right, so when you're in the formation stage, a lot of it is about getting incorporated, installing some foundational accounting and finance structure, which in many cases will just be a bookkeeper. All right, and you're starting on FP&A, which is largely focused on cash flow. All right, as you get into Series A, you start to invest in technology to scale, and that's a lot around what Andres just walked us through. Right, those different platforms, getting them integrated and getting them to talk to each other. Right, good companies also really, when they're early on in the Series A, start to look at establishing the revenue recognition and the booking policies. It's just all too common, unfortunately, right, to get into a restatement situation. And unfortunately, those tend to come up at the wrong time, like when you're doing fundraising or you're doing an IPO and so forth. So invest that time up front. It'll pay off later for you. Also, you're looking at establishing pricing and customer credit policies, making sure that you're going to market in a consistent fashion. You're starting to evolve your FP&A to a full P&L and cash flow forecast, and we'll be diving into that point a lot more in the slides coming up. And then also, this could be Series A or it could be later as well, but looking when the opportunity presents itself to do some sort of an asset-based loan, which typically is venture debt. That's a great opportunity that can help defer the timing of having to do your next financing round. So as you get started in the later stage, which could be Series B and beyond, you're looking at much more robust FP&A, right, involving different stakeholders, much more sophisticated plan and being able to operate around that plan, and looking at various tools that can move you outside of Excel. You're also starting to look at different, establishing your corporate governance policies, and then also getting ready for financial statement audit.
I'm just going to add, I think you touch on it, but I don't think we can touch on it enough, is that process and documentation. And as you add on new things, and we'll be talking about it later as far as rolling out an equity plan, and that's a whole nother layer of complexity. But again, documentation, having proper controls in place. Again, we're not talking about, excuse me, we're not talking about SOX controls. We're just talking about, internal controls, who does what, who owns what process. It's all important in these various areas that John's talking about. We'll talk more about it when it comes to equity compensation as well.
Yeah, definitely. All right, so let's double click into the operating plan itself. We got a couple slides here. And so some kind of best practice recommendations here to talk through. The first is what I refer to as just the 80-20 rule. All right, focus your energy on the drivers that will have the largest influence on the plan. All right, so you're going to have a set of variables that are pretty predictable and stable. All right, you can largely forecast those based on historical trends. Just get that into the plan and really move on. All right, so where you want to invest your time is those variables that are unpredictable and have a real material impact to the plan. Right, you want to double click on those areas, bring in data analysis, involve different stakeholders, and go around the horn a couple times. All right, that investment will pay off. If you get one of these drivers wrong, all right, your plan can get derailed pretty quickly. All right, the second is participation of divisional leaders really creates ownership. All right, get them involved as early as possible. Even if it is a shadow budget and you have a finance and accounting person who's putting together like a sales plan or a marketing plan or an R&D plan for a divisional leader, all right, have them participate and in the process, and that's where the terminology shadow budget comes from. All right, and then the third point, and I've seen this happen with a lot of startups, is they tend to get the P&L pretty accurate. They tend to get their operating expenses pretty accurate, but then the cash inflow they get surprised by. And that throws off the entire cash flow forecast, right? And the tendency is to be relatively smooth when you put your plan together. And then what you find is, in reality, the cash comes in a bit lumpy. All right, so a couple things to think about there. First is mapping your future invoices on existing contracts. So for your existing contracts, you should know when you're invoicing customers, and you know roughly what your collection cycle looks like. Right, and there's systems out there like Zora and SAS Optics that do this really well. Right, you should have a pretty high predictability and confidence level around your existing book of business. When it comes to new business, that tends to be much more challenging, and the companies who do it really well understand their sales rep productivity. Right, and they're not doing it basically just an average per rep across the entire sales team. They're understanding it at a more granular level. I refer to it as cohorts. Right? And a cohort group could be based on start date. It could be based on the channel, like enterprise versus small, medium-sized companies, and also different industry segments. Right? So if you can understand how well they're ramping up and kind of what their productivities level are at a more granular, you tend to have a better view into I guess really the key driver of what builds sales cash inflow is their productivity. And then the last point is partner with your sales team to monitor collections weekly. Don't wait till the end of the quarter and then go through a big exercise just to try to collect it at the end. Do it as you're going through the quarter.
So, John, we do have a question. It says, when have you typically seen a timing change focus from cash flow forecast, cash, to a GAAP financial statement forecast?
Good question. So cash flow definitely at the beginning stages is the core focus. And it really will be really through all your various kind of fundraising stages, because it's going to impact when you have to go back and then raise another round. GAAP becomes more important typically as you get more, senior investments, right, into your company. They're going to want to see what is the P&L, because they're going to start to think about, well, how do I take this company public? What's that P&L going to look like when we go on a road show and so forth? And it helps to better understand not only how do I make sure I pay all the bills and have a runway for 12 to 18 months, but really to see what does the profitability of the business look like.
Yeah, I would think also considering from a banking perspective as well, if you take on bank financing, that also might trigger some need for GAAP financials as well.
Okay, a couple other suggestions and best practices we see. So when you're designing the plan, a couple things here. You want to design upfront the ability to run scenarios. Inevitably, you're going to go through and say, hey, well, what if, this happens, or what if that happens? A lot of companies like to see, well, what does a light, medium versus aggressive plan look like? Right? Don't do that in different files because you'll have a hard time keeping each of them updated. Design it in the initial plan, put different switches in place so that you can run scenarios through essentially real time. The second is contemplate when you're designing your template for the plan to also be able to use it for the forecast as you go through the year. Think about how I can easily just plug in my actuals and then flow through updated assumptions for out periods as you go through the year. The next is this concept around rolling 4 quarters. And this tends to be more later stage startups, but the earlier you can kind of get into this mentality, I think the better. And the concept here is as you close essentially 1 quarter within a year, add on an additional quarter. So for example, if we just closed Q1 of 17, look to add on Q1 18 to the plan, right? And those numbers for the out quarters will be placeholders, but it really helps you as you get into the annual plan at the end of the year. You have a set of placeholders, you have a starting point, and you can avoid this big year-end crunch that a lot of companies go through.
Yeah, we see that happening a lot where startups really set their goals for the year, and then there's this tremendous drive in Q4 to be hitting the numbers, and everyone is focused on it, and sales is out there killing it every day. And then you get into January and February, and people are focused on, oh, okay, so what does my comp look like for this year, and what's the plan going to look like? And before you know it, it's already the end of the quarter, and you haven't even started to really materialize the strategy and hit your targets again. And so that can be super distracting. And so this rolling 4 quarter strategy makes a lot of sense.
Great. And then the last point here is avoid iterating to death. All right. So some good best practices: get top-down direction either from the board or from the executive team. Get that pushed out. Do your bottoms-up, more detailed, granular forecasting in your material areas, and then inevitably you'll have a gap, and if the CEO and CFO can come in and just make the decision and close that gap and move on, that's great. So now we'll talk a little bit about managing the plan, and the first point is budget to actual reporting. A lot of the time we get questions, how frequently should we do it, and we suggest monthly. If you go to quarterly, you're not able to react in a timely manner. If you think about it, you close Q1, you're already into April, and you're just seeing your first set of numbers and identifying your variances, and then you're looking under the hood why it's happening. You want to essentially be doing that each month and not get surprised. The second point is a lot of folks do their plan, especially when they're in the startup stage, they do it in Excel, and they can get quite sophisticated with it. I think Andres and I were talking yesterday. We've got a client who's got 50 tabs in their plan, and then you try to match your plan with your actuals, and you find you got a huge headache. So think about that when you're setting up your plans. Get your GL accounts and departments in there so that you can just press actuals and map it to your plan very quickly.
There's definitely a trade-off there between efficiency and sort of accuracy in your forecasting. And you know, as much as we're numbers people, and so we love to drive accuracy and get it down to that, you know, two decimals after the comma type thing, but it just doesn't really make sense. And so sticking with something that works and that's just a bit of a pragmatic approach in your budgeting makes a lot of sense.
All right, and then the next way is you make your budget to actuals as efficient as possible. Where you want to focus your energy is on analyzing trends and insights. That's where you add value. All right, so be proactive in understanding your trends. Don't wait for the board to come ask, why is this happening? And then developing a monthly and weekly cadences we recommend for the key business drivers. For your particular business, it could be sales productivity, it could be bookings, it could be cash collection, whatever it is. Get the stakeholders in the room, go through the data and trends on a regular basis, and just get into a cadence. The last point here is keep the plan locked as long as possible. Right? If there is a material change, yes, you're going to have to go through a replan. If you're going through replans before mid-year, it typically means there's an opportunity to improve that process. Like we talked about before, utilizing a mirror of the plan template to run your forecast and outlook drives a lot of efficiency. And I recommended before doing this 4-quarter rolling planning process. And just to be clear, we're just talking about recommending locking the plan for the current year. The out periods are simply placeholders. Okay, we're going to move now into KPIs and a couple of comments here. First of all, I kept a pretty high level. We could probably talk about KPIs for over an hour if we wanted to. Secondly, for just illustrative purposes, I do have some benchmarks, and they're largely focused on the software industry. And also, when we talk about benchmarks, a lot of it comes from the VC world, and a lot of it is what you aspire to, right, when you're in the later stages. So it might give you a little bit of context of what you want to grow into, if you will. Okay, so bookings versus revenue. I think most people are probably familiar with the difference, but if not, revenue is your revenue recognition on a GAAP basis. Your bookings is more on your contractual invoices that have come in. So if you think about it in terms of if I had $1.2 million contract on an annualized basis, your rev rec, assuming it's straight line, would typically be $100,000 or $100,000 a month. All right, then you get into metrics around your average revenue per either user or account. You hear ARPU probably a lot out there. Then you look at annualized contract value and understanding your book of business, and as it's coming in, they can be different time periods. Some could be 6-month contracts, some could be 2 to 3 year contracts, and you typically try to normalize that down to an annualized basis, hence ACV. As we get into recurring revenue, that's where there is a ton of focus. It has a huge influence on revenue, not revenue, sorry, but valuations of the companies. And those of you in the software world or working with different VCs, you know that the amount of attention in board meetings around recurring revenue and how it's essentially building month by month.
Let's maybe talk about recurring revenue for a sec, ARR and MRR. And what are some of the drivers, John, that you see that are really affecting this?
Yeah, so when you think about like ARR, and a lot of people might hear ARR roll forward, which is basically what your beginning recurring revenue, and then you add in new business, new bookings, and then you look at upsells, and then you back out churn, right? And that gets you to your ending. And within there's some benchmarks that I hear a fair amount from the VC world. The first is around churn, right? And you look at churn and breaking out between enterprise and I refer to it as SMB, small, medium-sized businesses. But I tend to see them looking at mid-single digits churn for enterprise and probably low teens for SMB companies. And then when you look at your existing book of business, which is a combination of upsells and churn, they're looking for that existing book of business to be 125% of last year. So about a 25% growth rate year over year.
I think that makes sense, John. We just got a question in. Somebody's asking if ARR is only for SaaS companies or if it's also relevant for service companies. I would say, and I'll let you chime in, John, but I would say that for a service company, it might be a little less relevant just because you don't know necessarily what your services sold are going to be, what that future revenue is for the next 12 months. Whereas if you're a subscription-based company and you've got a contract with a client, then you know exactly down to the last digit what that contract is for the next 12 months. As a service company, there's just a lot more variety there, and unless you've got a billing model that is more of a value-based billing model. But there's no sort of right or wrong, right? If your investors are asking you about ARR or your board's asking you about ARR, then yeah, if you can drive insights from it, you should be tracking it.
I just also add, regardless of what industry, if you're booking contracts that are long-term and you're expecting them to be renewed, and you look at it as an ongoing relationship that should continue, 90% of the time plus, I think it's fair to consider it recurring revenue, and ARR metrics can be applicable.
Okay.
Okay, and then I talked a little bit earlier about sales productivity, and that's a huge driver, obviously, of new business, right? And a couple of benchmarks within there. On the enterprise side, VCs tend to try to like to see reps with about $1 million quota, and a 70% attainment tends to be the average performance across a portfolio of sales team. So if you do that math, then attainment is roughly about $700,000 per sales rep on the enterprise side. SMB is more in the 300 to 400K range. And then there is this benchmark between bookings to compensation, right? And the ratio they're looking for is somewhere between about 3 to 4 to 1. And so the way to think about that is if you got a sales rep, they're all in compensation is about $200,000. They're looking for their productivity to be about 600 to 800K of bookings each year. And if sales reps can continue to bring in that new business at that level, and you're paying them, that amount, you have enough of a spread there that you can start to cover all your operating expenses. You hear probably a lot about CAC, and there's a couple different ways it can be calculated. There's more of the long-term or blended view, which can be an average over, the last anywhere from 6 to 12 months versus what have you paid for acquisition in the last quarter or even the last month.
And we did get a question in just now, real quick, about how do you ensure your CAC accounts for long sales cycles. I think that's exactly what John just said, that you want to separate out blended customer acquisition cost and paid. And so paid, you really look at, if I'm doing a campaign and I'm spending X amount of dollars on this campaign, then I know what my paid customer acquisition cost is just for the last 2 months, let's say. And blended, you really look at these longer sales cycles and potentially even from the beginning of the company. I do want to kind of, we could spend a whole hour just talking about the metrics, and I don't think we necessarily want to do that. So I appreciate the questions on this specifically, but I'm afraid that we'll move on and maybe take those offline, specifically on KPIs.
Okay, last couple of comments here. There is the ratio out here, many of you might be familiar with it. You hear about it, LTV, long-term value over CAC, 3 to 1. It's a great ratio. It's a great benchmark to try to aspire to. What I have heard, though, is that the VCs are a little less focused on this one versus some of the others. I think they're finding that there's a lot of subjectivity that goes into the calculation around LTV, and there's a bit of gamemanship out there. So they're relying a little bit less on that metric versus some of the others. And then the last one that gets a fair amount of attention is deferred revenue. Obviously, if your deferred revenue balance is growing, that means you are billing in advance. And if you're billing in advance and collecting in advance, that gives you a favorable cash flow. So they'd like to see that.
All right, great. We're going to move into our next polling question. Okay, so if you could please drop in your answer here. I expect to raise funding in the following time frame: between 0 to 6 months, 0 to 12 months, I'd say 12 to 24 months, no near-term plans, no need to raise capital. So we'd like to get the majority of you to vote here. Looks like it's spread across the audience. Okay, we're going to go ahead and close that poll and share with you the answers.
All right, so pretty evenly distributed. A little bit surprising here, though, as well. So I got a fair number in the next 6 months, which makes sense. You got a good chunk in the next 12 months, which I think makes a lot of sense as well. And then a very large chunk, no near-term plans at all.
Well, that's great, right? Those are the guys that have some level of profitability, and revenue and profitability sort of sets you free from fundraising. So,
or a lot of money in the bank.
Or a lot of money in the bank. Exactly.
Yeah, so that's great. Okay, so let's, we're running a little bit behind, so we're going to move kind of quickly here, but a couple of comments around raising money, the financial progression here. So your strategy, the vision, and the team, that's always going to be the core part of fundraising. That's going to be front and center. And as you get into later stages, the financial alignment with that strategy will garner more attention. All right, so we talked about, early stages. It's a lot about bookkeeping and reporting actuals. Then you get into a growth plan. How are we going to acquire customers and users, and what do the economics look like around that? Then you get into your financial plan and executing against it. You get into proof points, like we talked about, retaining customers and growing their spend. You use those proof points to help establish a path to profitability. And like Andres was talking about before, that was a huge focus in 2016. It simmered down a little bit this year, but it could always come back at any point in time. And then it's really around expanding your business and scaling the economics. So one question that does always come up on a pretty frequent basis is, how much should I raise? And at the end of the day, there is no real magic answer, but a few points of perspective here. First, the amount of finance is a trade-off among many variables. Two that garner a fair amount of consideration. The first is the accelerated time to market, right? The more money you raise, the more that you can invest quickly. You should be able to get a leg up on your competition. And then the trade-off there is the dilution to existing shareholders. All right, the second point here is, I think I hear a fair number of VCs recommending this to their portfolio companies, is to raise as much money as possible as needed to get to the next fundable milestone. And this really aligns with what we've been discussing over the last 15 minutes, which is developing a plan, establishing KPIs, and operating around those to show that you're hitting the next milestone. Right, that's the best way to be able to get to your next funding round, and then be able to garner a higher valuation, which is what everybody wants.
Yeah, absolutely. I mean, when we look at companies that find it very easy to raise the next round, it is always the fact that you sort of under promise, over deliver. You said you were going to have this much sales or ARR, whatever it might be, and now you're hitting that or even doing better. Well, great. Let me just write you a next check. I would say the other factor here is probably also market sentiment, and if we're in a 2015 type of market again, or if people are eagerly writing checks, then yeah, sure, let's raise right now. That always plays into the fundraising strategy as well.
All right, then the last point here is annual prepayments are a great source of financing. And if you think about it, if you got the same amount of money from a customer, but it's an annual contract and you get paid up front, the impact on your cash flows is much more significant than you might realize. And it's a great way to get financing and defer to that next financing round where you're going to have some dilution. So keep that in the back of your mind.
Which isn't to say, you're never going to raise money just to finance your working capital. No one's ever going to write you a check for that. So just make sure that it is about those next milestones.
Well, in talking about dilution, I mean, I think that's one of the key considerations when raising is that cash flow versus dilution question. And that kind of leads right into kind of talking about stock option and equity plans. And one of the challenges when we talk about it, and this is all anecdotes from clients and prospective clients and just talking to folks in the industry, equity plan management and cap table management, it's a pain. It's challenging. It's a fragmented process. It's costly. A lot of service providers. And so it's how do you manage that and really manage it from the beginning? From a founder's perspective, right on the onset, if you're starting and there's 2, 3, 4 founders, make sure you have good legal agreements in place that allocates properly. However, whatever you decide is the right amount of the percentage of the company to the founders. But you want to make sure that there's open communication, why people are getting what, and how that's divided. The other thing then is when you get to that first or second employee, what are we expecting to give up for that first or second employee? And do they have the skill set to match it, right? I think it goes both ways. A lot of times, I think if you're going out for a job and you're the first employee, you automatically think, hey, I should get 5% of this company. or maybe even as a company you think, oh, I got to give my first employee 5% or whatever it is. Well, A, there's no set amount, but B, they got to make sure the skill set matches up what you're giving up. And this last point on diluting your ownership as a founder or founding group by poor plan management is really important. A key piece is when you create your articles of incorporation, make sure you build in room in your authorized common shares for a plan, for maybe a seed round that might be common and not preferred, right? So don't have your founders own 20 million shares and your authorized is 20 million shares. That leads you to just have to do another, $2,000, $3,000, $5,000 cost to file another articles of incorporation. So make sure you plan ahead and make sure you also build your pool into your authorized capital. And this is really important when it comes to funding, right? The VCs or private equity or seed investors, they want to know that when you come to the table, you're thinking about your next hires and that you've reserved X amount in your pool, and you can explain it, right? You don't have a pool that's 25% of your total outstanding and you don't know why, but you can say, hey, I know I need to give the CTO that I'm going to hire in the next 6 to 12 months this percentage, and I'm going to hire a CFO, or likely you're using somebody like the Brenner Group at the beginning, but making sure that you understand and you can properly plan. So John talked a lot about operating plan from a cash flow perspective, from a sales perspective, but the other side is also planning your pool, right? When do you expect to allocate that, et cetera? And investors want to see that as part of funding. They also want to see that you know who's invested in the company, know what type of agreements you have. So if you're issuing convertible notes or warrants or things, making sure that you don't issue those with certain provisions so that the next investors, when you go to get funding, that doesn't trip you up.
Scott, what's the typical pool that you see from a percentage size point of view being set aside?
Yeah, I mean, I think it really depends on the stage, but I'd say anywhere from 10 to that 20% of the pool kind of reserved. Again, I think as you grow and scale, you're going to have less and less of your pool because you're just going to have more shares outstanding. But I'd say that's, you want to reserve that pool for your next key hires. So now talking about actually rolling out and setting up an equity plan, right? When you just have your founders, you don't necessarily need to create a stock plan, right? Again, you want to be cost conscious, cash conscious. It's really when you have that first, second, or that key employee that you want to then roll out your equity plan. And rolling out your equity plan, there's a lot of components to it. It is costly. I'd say probably the biggest takeaway from this slide here is making sure that you properly document your plan, your agreements, and the transactions. We find a lot of times things get written on the back of envelopes or napkins, hey, I'm going to hire this guy and I'm going to give him 200,000 options. Making sure that that's in order saves you lawsuits, it saves you stock-based comp issues, which we'll talk about, but it just saves you headaches and time and effort. So making sure you have policies in place. Again, they don't have to be full blown out documentation, but hey, the board has to approve all options, or the CFO and the CEO have to sign off on all new grants, as opposed to just having it be unilateral with one member of your executive team. So, and dividing up ownership, right? Legal is going to do this function, HR is going to do this function, tax is going to do that function. I would say if you can consolidate, right? So if you can have less hands in the cookie jar, so to speak, for example, finance, tax, maybe that can be all handled by one person, and HR is a separate one, and legal is maybe outside counsel or something like that. Limiting that fragmentation of the process is important, and that's again where you can look at outside vendors and say, hey, can they do 2 or 3 of these functions rather than just one, and having to have 4 or 5 different vendors or even stakeholders, I'll say 4 or 5, 2 of those people internally and 3 of those people externally. So that's really, again, I think an important part of the process. Thinking about stock-based compensation, I think that's our next slide. Oh no, talking about tax issues. So we could talk a lot about the tax challenges, but couple of the key areas you want to focus on. If you are issuing founder stock, you want to make sure if you're going to file an 83B, which allows you to accelerate the tax impact. So when you're founded, right, your company is maybe worth a penny or 10 cents a share, basically what you kind of decide is reasonable. You want to pay taxes at that level, right? So you want to make sure you have to file the Section 83B filing on time. Otherwise, there's tax consequences, there's impact to the stock, etc. Another thing to consider, if you're allowing early exercise, which again, a lot of early stage companies do allow early exercise, and that's great. But be conscious, again, as you start to scale and your market price, your fair market value with the 409A valuation starts to increase. With that early exercise, your incentive stock options, which are very advantageous to employees, you could start triggering a $100,000 limit and actually be giving somebody non-qualified stock options. And that might be fine, but that's something as a company you have to understand, and also you want to have your employees understand as well. Again, no obligation to educate your employees, but you do have an obligation to withhold the right amount of taxes should it be a non-qualified exercise. So I think in setting up your stock plan, understanding the different impact both from a cash flow, both from a tax perspective, both from an employee incentive perspective and understanding is important. So whether it's stock options, restricted stock, performance-based awards, just selling shares of common stock. There's a lot of different components. Maybe you do I was talking to a client today, maybe you do a 401k match and you reserve, again, that requires cash flow, which you may not have, but then you can reserve some dilution for your option plan. Again, it changes as you scale and grow and what you have as far as cash flow versus being able to dilute the company. The other item on that, the last item on that slide is be aware of granting options that are in the money, right? That's a big no-no, a lot of tax consequences of that. I won't go too much in detail into this slide given the essence of time, but again, I think it gets back to having clear processes, making sure that what goes to the board is what you end up granting. And so you don't have a disconnect, right? You haven't promised somebody in their offer letter 50,000 options. The board approves 20,000 and then you're granting them 20,000. Then you have an unhappy employee. So you just turn an incentive into disapproval and somebody who's going to be upset. Equity accounting is very challenging. I can't cover it in one slide, and this is really a takeaway slide. But I'd say one of the common things we see with startups is we grant somebody an option today, even though they're not starting for 3 months or 2 months, or maybe it's 1 month. Well, if you grant somebody an option today and they're not yet an employee, you can't grant them an ISO legally and from a tax perspective. Secondly, you've now triggered a mark-to-market component versus just having it be a very simple expense calculation. One of our clients is on the call today, I see, and they had some challenges with this in having to mark to market folks they thought were employees but were really non-employees at the time of grant. So something to consider in modifications. We see a lot of early stage companies, hey, I want to accelerate this person, I want to extend their time to exercise. Just be conscious. It's great. I never say don't ever let accounting drive your business decisions, but it should be part of the discussion. What is the impact? What is the pain this is going to cause me, not only from an accounting perspective, but also from a tax perspective?
Okay, we are right at the end, so I think
We can skip the question.
yeah, we're going to skip this polling question and move on to wrapping it up.
Yeah, so we talked about the status of the market. We shared some best practices and spoke specifically about the financial plan, fundraising, and Scott spent some time talking about equity plan management. We are hitting the 11 o'clock mark. So.
Yeah, so you certainly are welcome to email any of our presenters. We've put their information there up on the slide. So if you have a specific question that came up from the webinar, please go ahead and reach out to them. I want to thank Andres, John, and Scott. Great job today, and thank you for joining us.
And yes, we will be sharing the slides, so don't worry about that. And if you have a question, you can also type it in, and we can reply to you via email outside of the webinar. So we'll stay on to see if there's any questions. But thank you, everyone, and have a great weekend.
Yeah, thank you so much.